and you say, my view of risk is different, but you also acknowledge that some of these risks could happen. Maybe they're just lower levels for you. And so you may start to consider allocating some money to precious metals. Why? Because there's medium risk of owning precious metals right now if the price moves backwards, if you're a 60-40 investor. But also you recognize that precious metal could alleviate some of the risk of stocks and bonds if there's an issue in that market. And so you say, yes, I want some precious metals. It's now within my risk tolerance. Hey everyone, this is Rob Kientz from goldsilverpros.com. And for today, I'm going to be answering a question that I get asked probably number 1 or 2 in all the times I get asked, whether it be through social media, emails, whether I'm out and see someone or I'm at a conference. How much gold and silver should I buy is one of the top 2 questions that I typically get. So I thought, hey, why don't we just create a video and talk about it? Now, I do want to do a disclaimer. I'm not your financial advisor. This is not financial advice. This is also not legal advice. Please do your own due diligence and consult a financial advisor and or a legal professional before making any investment decisions. And we're not doing this exercise as a way to promote any type of asset. I'm just going to walk you through a risk managed process. So we're going to talk risk management and just in figuring out what the risks are and how we may want to apply different investment classes to address those risks. Again, this is a mock scenario. This is a simplified risk scenario. It's there to help you build out your own risk assessment process, which really is the key here. It's not the specific investments. It's the process of getting to where we're investing with risk in mind and understanding what those risks are. So I'm going to give you 2 possible scenarios that we're going to go through with the understanding that this exercise really is for you to do for yourself. This is an example I'm putting together based on 2 different investment scenarios, but this is not advice because your scenario is necessarily going to be different. Therefore, your risk analysis in your portfolio must necessarily be personalized to you, and the only person that can do that is you. All right, without further ado, we're going to get into what I see in the markets, and I'm going to show a very common screen that I show quite a bit. And this is basically just the returns that we've gotten in gold and silver compared to the stock market since 2000. Now, I am, to be fair, cherry picking data. I'm looking since 2000. The reason I'm doing that is because that's basically outlining this leg of the bull market in both gold, silver, and the stocks. So we had a bull market in both, to be fair, over the last 20 years. Most people think that the stocks did better than the precious metals. But if you look over the last 23 years, because we're dating back to 2000, you can see 2000 right here on the edge, gold and silver have done a lot better than the stocks. And so stocks have done well. And if you own stocks, you did pretty good. The Dow Jones Industrial, 200%, according to TradingView. The S&P 500 up 184% since 2000 over the last 23 years. That's a pretty good return. Gold just happens to be up more. You can see the percentage here, and silver is up more. One thing you'll also notice is that gold and silver kind of follow each other, but at times they diverge, and silver tends to be more volatile. So when gold reached its all-time high, its previous all-time high of $1,900 in 2011, silver as a percentage moved higher. These are all percentage moves. You can see percentages here. We're just looking at percentage change of investments. So if you had invested $1 here, what would be your percentage return in each one? And that is what this chart depicts. Silver is a little bit more volatile. Gold's a little bit more stable. Silver gets love later than gold. Gold's doing a little bit better right now. Silver tends to catch up and then vault and then just kind of screech past gold at one point in time, but it tends also to come back down. So the one thing you want to know about silver, a little bit more volatile. Price moves can be bigger. And sometimes silver doesn't trade as well as gold until it catches up to gold. And typically that's when you have a big market run. When you saw the market run in gold go here, you saw silver diverge a little bit and then shoot past. And that is a pretty standard pattern. But overall, what I wanted to show with this chart is that if you had not put gold and silver into your portfolio, you were more of like a 60-40 stock bond portfolio, which is one of the scenarios I'll look at. Maybe it's time to potentially consider looking at gold and silver. Again, this is not investment advice. Please consult your financial advisor. So what I like to do is I like to put everything sort of on a spreadsheet. So what I'm showing here is a mock scenario analysis. And this is basically a 5-step process for risk management. Step 1 is identifying the risks. Step 2 is putting a value on it and then mitigating that risk with an action. And then step 3, 4, and 5 are basically reporting and revisiting. If you want to know what the risk management process is, you can go to jmbullion.com and look at their blog. I wrote 2 articles on the risk management process and the 5 steps. So look at that for reference, or you can just go to Investopedia and look up risk management, and they'll teach you. Of course, my corporate background is risk management, so I think in terms of risk. So what we're going to do on the spreadsheet is just look at risk. I'm not doing a mathematical exercise. It's more of an exercise in figuring out what the landscape looks like, and that's essentially what risk management is. And that's why we don't make specific investment recommendations. This is just a mock analysis, as you see here on the screen. So step one is identify risk. Now, I've identified 1, 2, 3, 4, 5, 6 risks. I would tell you that if you're doing this at home, you want to identify and do a brainstorming exercise here in column A and figure out all the potential risks that you see or that could potentially happen, maybe even if they're not happening now, and put them into a big list and make this a much longer exercise. For brevity's sake, and to keep this simple where we can do it in a video, I'm just doing these. This is by no means a full list. And then in this column, I just put what are the consequences. So for example, if the risk of a 30% stock market downturn occurs, which is not unheard of during recessions, then what the potential consequence is that you have a severe drop in the portfolio value and it doesn't meet your current term objectives or your retirement objectives. That's a risk. What's the risk probability? Well, given the fact that just about every analyst is calling for a recession soon, and we know that typically in American history they occur anywhere from 4 to 10 years, and we're way past 10 since we had our last one, the risk probability therefore is high. This is not a mathematical number. It's a concept saying, I think it's high. And it's based on my view of the market. And that's why this is personalized and everybody has to do their own. And why I cannot do it for you is because these risk probabilities will be different for you based upon the way you see the market, how you participate, and what you think could be coming down the line in the future. We're hypothesizing as to what could happen. Personally, extended high price inflation and interest rates, I think the Fed has already been raising interest rates. We've already seen high inflation. So that risk probability is very high. And it's very high because I do think that it's going to continue to occur. Loss of job I put as low because in my particular case, I work for myself. I don't have a job. And I know that there are job losses right now. So this may change for you. If you're working out in industry and you have a job with someone, this may be medium or even high. Certainly, if you're working in the tech sector, it could be high now because there's been a lot of job layoff announcements. So again, this value may change for you. Official recession, I say medium because I think we're going to have it. Bank run and closure, right now it's low. Now, this could change if one bank closes their doors for a day. This risk probability for the rest of the banking system goes way up. Right now, I'm just putting it at low. And a lack of portfolio growth, if I don't get enough, basically, this is the general risk that if I don't get enough return in my portfolio, I can't retire or otherwise meet my retirement objectives or even my savings objectives, if you will. This column, risk level, if it occurs, is just what is the risk if it actually happens? This is the probability it might happen. This is the amount of risk it adds to you and towards you and your family if it actually occurs. In this case, the stock market downturn, if it goes down, there's a lot of portfolio risk. And I'll show you another exercise in a moment, how we kind of, we apply that to a couple of sample portfolios for this whole column. High extended price inflation, that's a high risk to portfolio because it affects all assets, especially bonds and things like that, which are very sensitive to interest rate changes, stocks as well. Loss of job, medium, so on and so forth. Then I take these two and I kind of add them together. These two columns, C and D, the risk probability and the risk level, I add together to get a risk value. Why am I doing that? Because I want to know, one, this is a risk management exercise where we're looking at potential risks. So we got to give it a probability, because if you don't and you think it very well could happen, but you're not putting that into your view, but you think something else may not happen later on when you go to mitigate that risk, you may not be mitigating the risks are most likely to happen. That's why probability is important. And then the risk level of what actually happens. So you're doing like an expected value, if you will. Here's the risk that it could happen. Here's the risk to the portfolio if it does happen. What's our expected value for this potential risk overall to the portfolio, regardless of whether that risk is happening right now? And these are the blended values. Overall, when I look at a high, a very high, another high, and then two mediums and a low, if you kind of blend all that together, not mathematically, but in your mind in terms of overall risk levels, in a very simple sense, this is anywhere from a medium to a medium high risk, maybe low end high risk, if you will, because you got some lows and mediums in here. So the blended risk of these potential risks, the blended risk exposure is medium high, essentially. And again, you want to put more risks here. I'm just keeping this brief so you can walk through an exercise. You may put this down on paper and have 100 risks or 200, or you may only have 10 that you're worried about. Again, this is very personal for you to decide for yourself. This is a mock exercise. So what we want to do now is say, okay, these are the risks that could happen to me overall in the market. The next exercise is looking at a mock portfolio and looking at those risks and how that portfolio can reduce that risk. And we also have to take into account the individual risk of each investment. So this is a made up portfolio, doesn't belong to anybody, but a made up portfolio of somebody who's a generalist and invests in a lot of things. We'll call this the generalist portfolio approach, if you will. So this is generalist portfolio. Maybe they have 25% of their portfolio in stocks and they're not even getting into specific sectors. Maybe they have some broad ETFs, maybe S&P 500, maybe whatever. And maybe they have a couple of stocks mixed in, but we're going to call this in general non-specific. You're not targeting an area. You're just, the average 401k holder. You got a couple of different funds. You're kind of peppering your exposure around. This applies to a lot of people. Bonds, a lot of people have bonds. Residential real estate, some people have rental properties or second homes in which they get some rental income. Precious metals, some people invest in precious metals. And of course, cash. Cash itself is an investment. It's a negative yielding investment because of inflation and the reduced value in cash over time. But what cash does is it helps deal with other risk, and we'll talk about in a moment. Then we've got the description, some general details. This is personal to you. This is things like, I really don't want to sell this investment. I love this investment, or I'm reluctant in this case due to a company match on stocks because they're in a 401k. So you have to look at the vehicle saving in as well. So put that into the description because it may be hard to move in and out of certain vehicles. And that, by the way, is a risk to your portfolio as well. If you're in a 401k or a pension and you can't move that money out, what you may be able to do is move it around in different assets, but that's a risk in and of itself. It's a somewhat inflexible investment. And that's a risk, is the investment type itself. And then here's the risks of owning them. The risk of owning stocks is that you have a stock market downturn or official recession, you lose value. Where did we capture that? We captured that in step one, risk. This is a risk we're recognizing, and we're bringing that risk in step one over to our scenario over here in column D under risks of owning. What about bonds? Well, higher interest rate reduces the face value of the bond. Where do we have high interest rates? Right here. And it's a very high risk, as you can see. Okay, so that's a hint as to where we're going to put risk on a mock portfolio. What if you have residential real estate? What's the risk of owning it? Where if your tenant loses their job or gets in a recession and can't pay you, you're not getting money in, but you may have a bank loan. That's a risk to your portfolio. You have less money coming in, more money going out. Even if you had paid off that rental property completely, you may have expenses. Risk owning precious metals. All investments move up and down. So for every investment, the risk is lack of portfolio growth. Essentially, they could go up or down. In this particular instance, gold has been doing well the last few years, actually dating back 2016. So there is a lack of portfolio growth, although I think the risk is fairly low. And then for cash, the risk of owning, what if there's a bank run, you can't get to it, or price inflation, as I talked about before, reduces the value of cash. Now, if you go over to step two here, you've got the risks, the overall blended risk values of these 6 potential issues. And so this is where we brought these into here. We brought those values into here. There is a high risk to owning stocks, very high risk to owning bonds right now, medium risk to owning real estate, medium to precious metals, high for cash. That's my assessment. Yours will change because your risk levels here are going to be personal to you. And so your blended risk level is going to be different. And the risks that you identify and the potential consequences will be different. But for me, this is what I put. So then I said, what risk am I mitigating? Well, if I own stocks, it addresses lack of portfolio growth because stocks tend, when they're in a bull market, tend to do very well. Now, on the flip side, if you're in a recession, they drag down portfolio growth. So stocks are either good for portfolio growth or bad. Generally, it's on or off for those. For bonds, it helps if you have a lack of a job because you can sell them. They're fairly liquid. They're bonds. You can sell them. Now, you may take a loss, but at least you can get your money. It's a type of asset you can sell in the secondary market. It also could address lack of liquidity. So if you get cash poor for a minute, you didn't have enough cash, you need to pay expenses, you could sell a bond. You could also sell a piece of real estate, which takes longer, or a stock, which may be quicker. It just depends on how those are doing. If you need to sell something, what's the least amount of loss you're going to have? Lack of portfolio growth, all of them. Precious metals mitigates them all because when precious metals is going up, you don't have lack of portfolio growth. You have appreciation. But precious metals also addresses a stock market downturn, extended high price inflation, loss of a job, an official recession, a bank run. It addresses all of those. Why? Because physical precious metals in your possession allows you to sell for cash. It allows you to deal with a market downturn because when the market downturns, precious metals generally go up. We saw that on the chart that we had earlier today. That's why I put that chart up. So what's a risk mitigation while holding? So each asset class actually reduces risk. It brings risks here, owning, but it also reduces potential risks that you have. So you have to do a blended rate. When you have an asset, it could address a risk that you see here. It could also create a risk that you see here, or one that you haven't even put. And so you have to look at both sides of the same coin for every investment, including precious metals, bonds, stocks, real estate, cash, whatever. And so then you blend that into column H, and you say here, there's a high risk of owning stocks at this particular moment. They're not mitigating a lot of risk, and so it doesn't fit within my risk tolerance. Oh, new term. What is risk tolerance? So risk tolerance is basically saying, what is your risk appetite? Right now, I have a low risk appetite. I don't want to take a lot of risk. I'm a little bit older, in my late 40s. I'm not going to be as aggressive investing as I was in my 20s. So your risk tolerance level in your 20s could be much higher. You can take more risk on. When you get to my age, it may come down a little. It depends on demographic factors, how much you may need. If you're saving for retirement and you want to go be ultra safe versus if you're young, if you're older. But if you're younger and you got long time to sell for retirement, you may take more chances. Okay, so this risk tolerance is something you define for yourself. Right now, if I'm looking at the stock market for me in my personal situation, the risk of owning are high. The risk mitigation of owning them where it takes risk out of the portfolio is low. So therefore, these don't fit in my risk tolerance. So because it's 25% of my portfolio value, but they don't fit within my risk tolerance because the risk of owning them is high and the risks they reduce are low, then it doesn't fit my own personal risk tolerance. So my strategy for myself is think about either reducing or holding the position. Now, in this case, I may hold. Why? Because I'm getting a company match. So that reduces the risk because you're getting some free money in there. Now, the question is, does that free money offset the loss of the stocks itself? Depends on how much that stock goes down. That's for you to decide for yourself. And one comment here, this is a very simple portfolio. You could blow this out and make it as complicated as you want. You could put actual number values in here and get really engineering with it if you want, really engineer your risk assessment. I like to keep it high level because that allows, because I don't know what the absolute outcome of the market's going to be. So I don't have an absolute measurement system developed. I have a flexible system because I think I need to be flexible because risk can come from anywhere. And that's what you do in risk is you're not looking for exactness. You're looking for direction. You're looking to mitigate risks. You're looking from a strategic level, looking down at your portfolio and saying, what should you do? So this is a management process. It's not meant to be a valuation process. We're not doing like Black-Scholes trying to value our investments. We're trying to, from a management perspective, manage the risk of the investments and how those investments can manage risk that we see coming down the pike in the future. So anyway, these are my values here. So if you look at, let's take one in which it's within risk tolerance. So we look at residential real estate, which right now I don't own. It's not my portfolio. That's why I say this is a mock exercise. I think the risk of holding them is medium because I think, yes, some tenants could lose jobs, but not all will. So yeah, if I had a couple of properties, one may lose, one may not. There's medium risk there. There's medium risk of it does mitigate some risk because there's cash flow there. Let's say I'm getting a few $100 each property in cash flow from the properties and the tenants don't lose their job. Well, what does that do? It provides portfolio growth, but it also may provide liquidity in times of a market downturn. And so in that case, I said, you know what, maybe I'll hold those properties. It does fit within my risk tolerance because it's a medium risk on the risk that that it addresses, and it's a medium risk that it brings. And so therefore, I say that's within. Same thing with precious metals. Yeah, there's a lack of portfolio growth, but even so, over the last 6 or 7 years, precious metals has done okay. We saw that chart. So there is a medium risk. There's a high risk that it mitigates. Why? It's mitigating. Precious metals mitigates all the risks that you found in my mock scenario analysis, the risks that I identified in step one. Precious metals can deal, in a bull market, addresses all of these. And so I put all of them. And so it mitigates risk at a high level. That's a positive thing. When we're saying high here, we're saying it's reducing risks. When we're saying high here, it's saying it's introducing risk. So column E is introducing risk to the portfolio. Column G is reducing. The blended value is H. And so we say, yes, there's medium risk of holding it now, but it's very good at addressing all the risks that we've identified. Therefore, we want some in our portfolio. And how much you put in here and how much you rebalance is up to you. You may want to do 9, you may want to do 50%, 5%, anything that you want to do. And then cash, there is risk here because of inflation. Now, a bank run I put as low for now. That could change, but right now we know we have high inflation and interest rates, so that has to be very high. But that's also blended with the fact that we have low on bank closure. So those are the two risks: bank closure and high inflation. This one's very high. This one's low. So when I look at the overall mixed value risk, I put high. It's still high because we know we're going to have inflation, higher interest rates. Cash right now is not mitigating a lot of risk other than loss of liquidity and loss of job. Okay, we look at loss of liquidity and loss of job. It was a low risk for us at this period of time, but medium if it does occur. So we apply more of a medium risk to the medium to low risk of that. And then lack of liquidity is a low risk because we have all these other assets. So it's blended low. Therefore, it doesn't really fit within our risk tolerance. So we may reduce cash potentially, or we may keep it. We may keep a cash bucket and say, even though it's not reducing a lot of risk, I'm really worried about the lack of liquidity. So even though it's a no within the risk tolerance, I'm going to keep some cash anyway, just because lack of liquidity. If I have a liquidity event and I can't sell the rest of this to pay my bills, maybe I need to keep cash. So lots of ways to look at that risk. And again, this is very personal. This scenario is for a mixed asset portfolio example, mixed asset. This is more of something that a lot of people have, which is a 60-40. And it's not technically 60-40. It's 59% stocks, 39% bonds, and 2% cash, because everybody has some cash. But we're going to call it 60-40 and say we don't have residential real estate. We don't have precious metals. I just have stocks, I just have bonds, and I have cash. A lot of people out there. But we're applying the same scenario now. So we're saying the same 6 risks here are going to apply. These same ratings are going to apply. That we're going to bring over the same risk values we see in step 2, and we're going to put them right here. But I've highlighted these 3 columns in yellow because these are going to change. Why? The portfolio mix has changed. Because a portfolio mix has changed, these values are going to change as well. And let's say I only find a medium risk from owning stocks, and they provide me more risk mitigation. In other words, I like stocks, and so now they're within my risk tolerance. So if you're a 60-40 investor, you may still see stocks as being in your risk tolerance. You may still see bonds as being in your risk tolerance because your view of risk is different. You go back and change these risks and you say, my view of risk is different. But you also acknowledge that some of these risks could happen. Maybe they're just lower levels for you. And so you may start to consider allocating some money to precious metals. Why? Because there's medium risk of owning precious metals right now if the price moves backwards, if you're a 60-40 investor. But also you recognize that precious metal could alleviate some of the risk of stocks and bonds if there's an issue in that market. And so you say, yes, I want some precious metals. It's now within my risk tolerance. There's a medium risk of holding, but there's a medium risk that it addresses. So the blended risk is low. It meets my risk tolerance, and so I'm going to consider increasing holdings. Same thing with cash. You may say I only have 2% here. I'm 59 and 39, and maybe I drop these down to 55 and 35 and put 5% in precious metals, just a nice conservative position. But then I also need to bring up my cash a little bit because I don't necessarily want to sell my precious metals if I get into a liquidity event where I need money. So maybe I increase a few bucks in dollars. Okay. So now you're just creating buckets. You're creating a little bit more in cash, a little bit more in precious metals, a little bit less in stocks and bonds. You're not fundamentally changing away from a 60-40 portfolio. You're just saying, I see the risk is increasing. Okay. The risk is increasing here. So I want to address this by changing my risk mix, but keep within my risk tolerance. In other words, you're not changing the amount of risk you want to take on. You're rebalancing this portfolio to address the existing risk that you see. Okay. So this is just a really simple mock strategy. Again, this is just scenario analysis. It's not financial advice. We're just applying risk management in an academic exercise to a mock scenario. The values that you have for your mock scenario are up to you. How many risks that you want to mitigate is up to you. There could be one risk that you want to mitigate. There could be 2,000 risks that you want to mitigate. So you can make this as simple or as complicated as you need. You assign your own risk probabilities. You do a blended value there. That's important. You fill out the steps. You can make it more complicated. If you wanted to put some math behind it and say, here's my portfolio value, but I actually want to assign, instead of high, medium, very high, low, I want to do 10, 20, 30, 40, 50, 60, 70, 80. I want to get more precision. You can do that too. You can actually put risk percentages here if you wish and turn it into more of a mathematical formula. I avoided that for the most part because I didn't want it to be about math. I don't want math to prevent people from thinking about risk. And again, going back to risk deals more with probabilities than absolutes, because in the future, there is no absolute. We don't know what's going to happen exactly. So we deal in probabilities, and risk is a way for us to think about top down strategically. What are the risks to our portfolio, our savings, our investments? What are the risks that each additional investment, or the ones that we already hold plus each additional one, brings to the portfolio? And from there, blend those risks together and say, okay, now that I've got that blended risk rating, what changes do I want to make? And again, it's very personal, because the risk that you see may be different than the risk that somebody else sees. And the risk that you perceive from each asset could be different than the risk that another person perceives. And that's why financial advisors pretty much have to say and will say, or non-financial advisors don't license have to say, this is not financial advice, because it's different for every person. And that's why there are licenses there. But that doesn't stop us from doing an academic exercise and looking at potentials, because what we're really doing is teaching a process. I'm not trying to tell you how to balance your portfolio. I'm trying to teach you how to apply risk to your portfolio so that you can address risk. So going back to the question I get asked at the conferences, via email, social media all the time, how much gold and silver should I buy? Well, that question, that answer really is up to you. But what I did today was give you a concrete process that you can use to begin evaluating that. And you don't have to stop. You can make that process as simple or as complicated as you want to fit your individual needs. And I think that's where the value of risk management comes, is you're not only defining what could happen for yourself, and nobody else has to do it for you. You can personalize it. You're also defining how you're going to react to that. And this can be applied to any portfolio of investments you have, whether you have existing investments or not. And in this scenario, I went over two different, in this video, I went over two scenarios to give you an idea: a blended one, which is very popular, and a 60-40, which is very popular. Now, you could have a completely different portfolio. Then again, you would do this exercise. You would use different risks and different portfolio, or different investments in your portfolio, right? If you have no investments and you're brand new, God bless you for watching this video, because you're going to be so far ahead of everybody else, because you're going to look at risk before you put a dollar into anything. Most people don't. So this is a good answer to how much gold and silver I should buy. Well, I'm not going to tell you how much. It's up to you. But here's a process you can use to figure that out. And by the way, that process is not only good for gold and silver, it's good for any investment. Not only that, it's not only good for investments, it's good for anything in your life. It's kind of cool. Once you get into risk management, you start in your mind assessing risks and doing risk management in your head for like other things in your life outside finance. It's really weird. Anyway, I do this all the time because I was risk management all the time. So you begin to just internalize this process and do it automatically. In any case, that's going to end it. That's my answer to how much gold and silver should you buy. Well, it depends. It depends on you, your personal factors, but we gave you a process to help figure that out. Hopefully that was helpful. Until next time, Rob Kientz, Gold Silver Pros.